What if I told you that the modern car, the one parked in your driveway right now, is actually hiding a chaotic, tangled web of over 100 completely independent computer chips?
Yeah, it's a mess in there.
Right, like completely dumb chips. Think about it. There is a tiny microcontroller whose entire existence, its whole job, is just dedicated solely to running your windshield wipers.
Just the wipers.
Just the wipers. And then there is another completely separate chip sitting in the door panel that just moves your power window up and down.
Right.
And then another isolated chip handles the anti-lock brakes. And none of these computers know how to talk to each other.
No, they don't. They're totally siloed.
Exactly. They're basically islands of silicon stitched together by literally miles of heavy copper wiring.
Oh, the wiring harnesses are huge.
Yeah, and this outdated, fragmented nervous system is the exact reason why legacy automakers are absolutely terrified of tech-first companies like Tesla.
Oh, without a doubt.
So today, we are looking at a company attempting to rip out that entire archaic architecture, right? And just replace it with a single massive supercomputer platform.
It is, it's arguably the most significant architectural shift in the history of industrial manufacturing. We are really watching the transition of the physical world.
You mean like cars, factory floors?
Yeah, exactly. Medical robotics too. We're moving from a collection of disconnected mechanical parts into a unified intelligent software platform. But getting there requires traversing one of the most brutal, unforgiving economic environments in the business world, which is the semiconductor cycle.
Right, the dreaded semi-cycle. And that is our mission for today. So welcome to this Talk Ticker's deep dive into the source material.
Glad to be here.
Today, we are tearing into the Q4 2025 earnings call transcript from NXP Semiconductors. Ticker symbol is NXPI.
Yep.
And our goal here is simple, but pretty ambitious. We are going to strip away the dense Wall Street jargon, ignore all that carefully crafted corporate PR fluff, and just deliver a data-forward, highly opinionated breakdown of exactly what these results mean for your portfolio.
We're getting right to the numbers.
Cold, hard numbers. We'll unpack the massive structural pivots happening behind the scenes, scrutinize management's guidance for the upcoming year, and ultimately deliver a verdict on whether the stock is, a screaming buy, a cautious hold, or a definitive sell.
And NXP is just a fascinating case study right now. I mean, they're a massive European chip maker, originally spun out of Philips decades ago, right?
Oh, right. I always forget they came from Philips.
Yeah, and they hold a really dominant position in automotive and industrial chips.
Mm-hmm.
But this specific earnings call wasn't just, a routine financial update. Management made some incredibly bold claims.
Like what?
Well, about having officially survived the bottom of a brutal inventory correction, for one, while simultaneously announcing, really aggressive divestitures, strategic acquisitions, and multi-billion-dollar investments in global foundries.
Wow. So a ton of moving parts. Let's not waste any time then. We have to start with the reality check, right? The actual numbers from the final quarter of the year.
Let's do it.
Set the baseline for us. When the press release hit the wire, what was the data that sent the algorithms into a frenzy?
Okay, so the headline revenue figure for the fourth quarter came in at $3.34 billion.
Okay, $3.34 billion.
Right. Now, in the context of the global semiconductor market, we have to look at the velocity of that money. That $3.34 billion represents a 7% increase year over year compared to the end of 2024.
Got it.
And sequentially, meaning compared to the immediate prior quarter of Q3 2025 revenue was up 5%.
Up 5%.
Exactly. But the metric that Wall Street cares about most is how that number stacks up against the promises management made 90 days prior.
Right, the guidance.
Yeah. NXP beat the midpoint of their own revenue guidance by a solid $35 million.
Okay, let me stop you right there, because a $35 million beat on a $3.3 billion base isn't exactly the kind of, monster blowout number that causes stock to double overnight.
No, it's not.
I mean, in the age of AI darlings posting 200% growth, 7% growth seems almost pedestrian. So why should you, as an investor, care about a $35 million beat?
Because context is everything in the physical chip market. Look, we are not talking about cloud software where you can scale revenue by just spinning up more server space.
Right.
We are talking about physical supply chains that have been in a state of absolute panic for 2 years.
2 whole years of panic.
Yeah. Everyone in the market was terrified of a double-dip recession in physical chip demand. Automakers were slashing production forecasts. Industrial hubs in Europe were slowing down.
Yeah, it looked pretty grim.
Very grim. So in that environment, delivering a top-line beat, however modest, proves stabilization. It proved the floor is solid.
Okay, so the floor is solid on revenue. But it's not just about what you sell, it's about what you keep.
Exactly. How does the profitability shake out?
Well, moving down the income statement, their non-GAAP earnings per share, the EPS came in at 3.35. And that was a very solid 7% better than what they had guided.
Okay, let's quickly define the terms here for the retail investor listening, because corporate earnings releases are just littered with the phrase non-GAAP.
Oh, constantly.
And it often feels like a magic trick to make the numbers look better.
It really can be.
So GAAP stands for Generally Accepted Accounting Principles. It's the strict, standardized rulebook. Non-GAAP is the company's internal adjusted version of the math.
Correct.
So why are we looking at non-GAAP EPS here? I mean, is management trying to hide something?
It's a vital question. While non-GAAP can definitely be abused in the semiconductor industry, it is actually the more accurate reflection of the ongoing operational health of the business.
Really, how so? Well, NXP has a massive history of mergers and acquisitions. Most notably, their historic merger with Freescale years ago.
Oh, I remember that.
Yeah, so under strict GAAP rules, they have to continually write down the intangible value of those past acquisitions every single quarter.
Which makes their official profit look artificially low.
Exactly. It makes it look terrible. Non-GAAP strips out those historical accounting ghosts, along with things like stock-based compensation, to show you the actual cash-generating power of the business as it operates today.
Okay, that makes sense.
So stepping over the bar by 7% on that clean metric shows genuine operational efficiency.
All right, so top-line revenue beat, bottom line earnings beat. I've read enough of these transcripts to know that when the top and bottom look shiny, the skeletons are usually buried in the margins.
You're not wrong.
Right. Did they deliver across the board, or was there a weak spot?
You have excellent instincts. The skeleton, or at least the source of Wall Street's anxiety on this call, lived directly in the margin profile.
Okay, lay it on me.
Their non-GAAP operating margin was strong at roughly 35%, which is actually up 40 basis points from the same period a year ago.
And for anyone furiously doing math, a basis point is just 1/100th of a percentage point.
Yes.
So 40 basis points means their operating margin improved by 0.4%.
Exactly. But the tension came from the gross margin. The non-GAAP gross margin came in at 57.4%. And that number was a slight miss versus their own guidance.
Oof. Now we are getting to the heart of the matter, because gross margin is the absolute holy grail for a semiconductor investor.
Like everything.
We need to dissect what this actually means. Gross margin is the percentage of revenue you keep after paying for the direct physical costs of making your product.
Yep.
It's the money left over after buying the raw silicon wafers, paying the electricity bill for the clean room, and, paying the technicians running the lithography machines.
Right. It doesn't include the CEO's salary or the marketing budget.
Exactly. So if a chip company's gross margins are shrinking, it usually implies one of two catastrophic things, right?
Really? Yeah.
Either their manufacturing costs are spiraling completely out of control, or they are desperately slashing the prices of their chips just to convince customers to buy them.
Right.
So force the issue here. Why did NXP miss on gross margin? Are they cutting prices?
That is the exact fear that gripped the analysts, and it was the very first thing CFO Bill Betts had to defend.
I bet.
The answer is incredibly revealing about how NXP's business is structured. The good news for anyone holding the stock is that this gross margin miss was absolutely not caused by pricing pressure.
Oh, really?
Yeah, they are not engaging in a race to the bottom, slashing prices to clear out dusty inventory.
Sure.
In fact, pricing across their core portfolio remained incredibly resilient.
Okay, so if it's not pricing, what is it?
The miss was entirely driven by what we call a mix issue.
A mix issue. Define that.
It basically means they sold a different mixture of products than they originally forecasted.
Different product.
Specifically, they saw a massive, unexpected surge in revenue from their mobile sector.
Wait, I need to make sure I'm hearing this correctly. They sold more products than they expected, which drove revenue up.
Right.
But that surge in sales actually hurt their overall profit percentage.
Yep, that's exactly it.
Let me try to visualize this. Is this like a movie theater that projects like a steady weekend of business? They expect to sell a normal amount of tickets and a normal amount of popcorn.
Okay, track it.
But suddenly, a massive blockbuster drops and thousands of extra teenagers flood the lobby.
Right.
Those teenagers buy the movie tickets, which are relatively low margin because the studio takes most of the cut, but they don't buy the insanely high margin large popcorn and soda combos.
Not a single popcorn.
Right. So the theater owner looks at the weekend spreadsheet. Total revenue is at an all-time high because the lobby was packed. But because they sold a disproportionate amount of low-margin tickets compared to high-margin popcorn, the overall average profit margin of the entire weekend actually went down. Is that what happened to NXP?
That is a brilliant analogy. It maps perfectly onto NXP's business model. In their portfolio, the core automotive and industrial chips are the high-margin popcorn.
Gotcha.
They command premium pricing because they are highly specialized. Look, if you were putting a radar chip in a car that is responsible for automatic emergency braking, that chip has to be certified to rigorous safety standards, like ASIL-D.
Right, you can't have that failing.
Exactly. It has to function perfectly in the freezing cold of a Minnesota winter and the boiling heat of an Arizona summer. And it has to last for 15 years without degrading. Automakers will pay a massive premium for that reliability.
And the mobile chips are the movie tickets.
Precisely. NXP's mobile division revolves heavily around secure transaction elements, the chips that allow your phone to act as a credit card.
Ah, like Apple Pay stuff?
Yeah, and ultra-wideband technology for spatial awareness. The smartphone market operates on brutal 9-month product cycles. It is fiercely competitive, and Apple or Samsung will squeeze their suppliers for every single penny. Those chips are absolutely still profitable, but the margins are inherently tighter. So, to bring it back to the theater, the high-margin auto and industrial popcorn sold exactly as well as management predicted.
But a busload of extra people showed up just to buy the lower-margin mobile movie tickets.
Exactly.
But, if I'm a skeptical investor, I'm looking at this and thinking, is this mobile revenue beat just a temporary sugar high?
A sugar high?
Yeah, is management trying to wave their hands and distract us with a spike in smartphone chip sales to hide the fact that their core industrial business is stalling out?
Well, that skepticism is required in this sector. But the data from the earnings call refutes the sugar high theory.
How so?
Bill Betts was adamant that the core segments did not underperform. The automotive and industrial businesses hit their internal targets.
Oh, they did?
Yes. The mobile beat was purely additive. You are taking more absolute dollars to the bank, even if the blended percentage takes a microscopic hit.
Okay, speaking of taking dollars to the bank, we need to look at the ultimate truth serum for any corporate balance sheet: free cash flow.
The most important metric.
Right, because you can massage EPS with accounting tricks, you can debate gross margins and product mix, but free cash flow is the physical, tangible cash left sitting in the checking account after paying to keep the factories running and investing in new equipment.
It's the real money.
What did the cash flow generation look like?
It was nothing short of a fortress-level metric.
Yeah.
NXP generated $793 million in non-GAAP free cash flow in the fourth quarter alone.
Wow. In one quarter.
In one quarter.
Wow.
To put that in perspective, that represents an impressive 24% of their total revenue.
Let that sink in for you, the listener. For every single dollar that comes in the door, 24 cents falls straight to the bottom line as cold, hard cash.
It's incredible.
That is an astonishing level of cash conversion for a company that manufactures physical hardware.
And it grants them immense strategic flexibility. I mean, they closed the year with $3.3 billion in cash sitting on the balance sheet against $12.2 billion in total debt.
That's a solid cushion.
Yeah. Their net debt to adjusted EBITDA ratio is sitting at a very comfortable 1.9 times. They are not over-leveraged. They are generating cash at a quarter of revenue pace, and the core business is stable.
So the foundation is rock solid. But historical numbers only tell us where the company has been, right? They don't tell us where the stock is going tomorrow.
Right.
To figure out if this inflection point is real, we have to look past the top-line data and uncover the aggressive, almost ruthless strategic moves management made while nobody was looking.
They definitely made some big moves.
So the overarching narrative of 2025, as CEO Rafael Sotomayor stated right at the top of the call, was that this year was a tale of two halves. Paint that picture for us. What is the difference between the first 6 months of the year and the last 6 months?
It is a textbook study in the semiconductor bullwhip effect.
Bullwhip effect?
Yeah, the first half of 2025 was defined by brutal, agonizing inventory digestion. Let's rewind slightly to understand the mechanics. During the pandemic, supply chains broke. Automakers panicked.
Right, nobody could get parts.
Because a $50,000 truck can't be sold if it's missing a single 50-cent windshield wiper chip.
That's
right.
Exactly.
So automakers and their tier one suppliers companies like Bosch and Continental started hoarding chips. They double and triple ordered.
They treated silicon like toilet paper in 2020. Just stuff it in the warehouse because we might run out.
Exactly like that.
Mm.
But eventually the music stops, car sales normalize, economic reality sets in, and suddenly these tier one suppliers realize they have a year's worth of chips sitting on their shelves.
Oh no.
So what do? They completely stop ordering from NXP. They just burn through their own stockpiles.
Ouch.
For NXP, the first half of 2025 meant underutilized factories, compressed margins, and a market terrified that demand was permanently broken.
So that was the trough, the darkest part of the tunnel. How did the narrative flip in the second half? Like, what broke the stalemate?
Time. The excess inventory eventually cleared out. The stockpiles were digested down to normalized levels. And more importantly, actual end market consumer demand began to rapidly accelerate, forcing those tier one suppliers to start ordering fresh silicon from NXP again.
Okay, let's break that acceleration down by the specific end markets, because NXP is not a monolith. They have distinct divisions. Automotive is obviously their crown jewel. How did it fare?
Automotive is the absolute engine of this company. For the full year, auto revenue hit $7.1 billion.
Massive.
And the critical, pivotal data point that every analyst highlighted was that in the Q4, the auto segment officially returned to year-over-year growth. Sotomayor specifically noted that Q4 auto revenue finished within 1% of its all-time 2023 peak.
That is staggering. I mean, if you read the macroeconomic headlines, you see endless stories about EV sales slowing down, global auto production staggering, and legacy automakers scaling back their ambitions.
Oh, everywhere.
Yet NXP's auto chip sales have essentially clawed their way entirely back to all-time record highs.
It speaks to a massive structural shift we will discuss later. But you can't ignore their second biggest market, Industrial and Internet of Things, or IoT.
Right, IoT.
This segment hit $2.3 billion for the year. And in Q4, it completely stole the show. Industrial and IoT surged an incredible 20% year over year.
20%?
Yes, that vastly outperformed their own long-term target of 8 to 12% growth for that division.
A 20% jump is massive for physical industrial products. We are going to dig into the exact artificial intelligence technology driving that surge in a moment. But before we get to the shiny new AI toys, we have to talk about the fact that NXP did some aggressive pruning this quarter.
We did. Very aggressive.
They didn't just sit back and watch revenue grow. They actively took a scalpel to their own portfolio and cut off the dead weight. What exactly did they divest?
They executed two definitive, ruthless portfolio moves. First, they finalized the sale of their MEMS sensor business to STMicroelectronics.
Okay, STMicro.
This was a significant deal that brought in $900 million in gross proceeds.
Stop right there, because we need to demystify this. What is a MEMS sensor? I hear this acronym all the time.
MEMS stands for Micro-Electromechanical Systems.
Micro-Electromechanical Systems. That sounds expensive.
It sounds incredibly complex, but the concept is fascinating. Imagine taking traditional mechanical devices like a diving board or a tiny weight suspended on springs and shrinking them down so incredibly small that you can etch them directly onto a silicon computer chip.
Wow, okay.
The most common example is an accelerometer. When your phone rotates or your car crashes, microscopic silicon structures physically move and bend on the chip, changing the electrical capacitance, which tells the computer that motion is happening.
So they are tiny mechanical machines built at a microscopic level.
Exactly.
That sounds like incredible technology. Why on earth would NXP sell a business that makes them? If it's generating revenue, why hand it over to a direct competitor like STMicro for $900 million?
It comes right back to our conversation about those precious gross margins. NXP's CFO, Bill Betts, was wonderfully transparent about the mechanics of this decision. While the technology is cool, the business reality was grim.
Grim how?
The MEMS sensor business operated at profit margins significantly below NXP's corporate average.
Dragging down the average.
But the real reason is rooted in manufacturing leverage. NXP designed these sensors, but they didn't actually manufacture the front-end raw silicone wafers themselves. They outsourced that complex physical manufacturing step.
Let me guess. Who do they outsource it to?
STMicroelectronics.
Wow.
Exactly. STMicro was already the foundry building the core of the product. NXP was essentially acting as a middleman.
So they were just moving boxes.
Pretty much. They would take the wafers from STMicro, package them, test them, and sell them. Management looked at this dynamic, looked at the shrinking margins, and realized they had no structural advantage.
None at all.
So they made the cold, calculated decision to sell the business to their own supplier, pocket the $900 million in cash, and recognize a massive $630 million one-time accounting gain that will hit their books in Q1.
That is the definition of ruthless capital allocation. It's exactly what you want to see if you hold the stock. Protect the overall corporate margins at all costs.
100%.
If the economics of being a middleman don't make sense over a 5-year horizon, cut the cord and take the cash. But they didn't stop there. They killed another division entirely, and this one didn't even get sold. They just took it out back and ended it.
Yeah, the second move was arguably even more abrupt. They announced they are completely exiting the RF power business.
RF power.
They aren't trying to find a buyer. They are just stopping all new product development immediately. They absorbed an immediate $90 million restructuring charge in Q4 to essentially fire the teams, sever the contracts, and wind down the R&D operations.
I need to understand the mechanics here because you do not voluntarily take a $90 million charge to earnings unless the situation is dire.
No, you don't.
RF power, radio frequency power. What do these chips actually do in the real world?
RF power chips are the heavy lifters of the telecommunications world. They are the massive silicon components sitting at the very top of cellular base stations.
Like cell towers.
Exactly. When a 5G tower needs to blast a radio signal across 3 miles of a city to reach your cell phone, it requires an immense amount of physical power and generates a staggering amount of heat. RF power chips take a weak data signal and amplify it massively.
Oh, I see.
Historically, this is a great business for NXP, using specialized materials like LDMOS and gallium nitride to handle the heat and power requirements.
But wait, if it's required for 5G, why abandon it? The world is consuming more mobile data than ever before.
Because the infrastructure build-out has peaked and the market dynamics have collapsed. NXP's communications infrastructure segment, which houses this RF power division, saw revenue plummet 24% year over year, down to $1.3 billion.
24% drop? That's a cliff.
It is a cliff. The major telecom carriers globally have slowed down their 5G capital expenditures. Furthermore, the competition from specialized players became fierce.
Oh, they just tapped out.
Pretty much. Sotomayor stated plainly that this business no longer aligns with their long-term strategic direction. The resources required to design the next generation of RF chips simply wouldn't generate an acceptable return on investment.
Wow.
So just like they walked away from the digital networking business a few years ago when it stopped making sense, they were letting RF power bleed out. They will continue to sell the older chips for legacy maintenance, which will generate a trickle of cash for a couple of years, but the R&D tap has been permanently and completely shut off.
Okay, so we have the full picture of the divestitures. They pocket $900 million from selling microscopic silicon diving boards, and they stop burning millions in R&D on dead-end cell tower amplifiers.
That's the summary.
The obvious immediate question for any investor is, where is all that redirected money going? I mean, if management is trimming the fat and freeing up hundreds of millions of dollars in engineering talent and cash, they better be building massive muscle somewhere else.
They are. Every single dollar of R&D saved and every engineer freed up is being ruthlessly redirected into 2 massive structural growth pillars.
Which are?
Software-defined vehicles, often referred to as SDVs, and what NXP is aggressively branding as physical AI at the edge.
Physical AI.
And they aren't just relying on internal development, they are turbocharging these specific areas using a string of highly targeted, quiet acquisitions. Specifically, they've integrated companies called TT Tech Auto, Aviva Links, and they bought the Canara NPU technology.
Okay, I am throwing a massive red flag on the play right now.
Oh.
Wall Street analysts love to throw around acronyms like SDV, software-defined vehicle. It looks fantastic on a PowerPoint slide at an investor day.
It does.
But I need you to prove to me that this isn't just pure corporate marketing jargon. What does it actually mean? Are we just talking about putting a slightly bigger iPad in the center console so I can watch YouTube while I charge my car? Is that an SDV?
No, it's not just a bigger screen.
Or is this something fundamental? Is this like upgrading a car from a basic keypad flip phone where the hardware dictates everything to a modern iPhone where the hardware is just a blank canvas vessel for continuous over-the-air software updates?
That's a much better way to look at it.
And more importantly, I don't care about a vision for 2030. Are automakers actually ripping up their supply chains and buying this architecture from NXP right now?
Yes. Your smartphone analogy isn't just close. It is the exact blueprint of what is happening. It is a fundamental rewiring of the machine. And to answer your second question, no, this is not a pipe dream for 2030. Sotomayor was emphatic on the call that these efforts are now material and global in nature.
Okay, I'm listening.
Let's break down the mechanics of why this is such a revolutionary shift. We talked at the beginning of the show about the chaotic web of 150 different computer chips inside a traditional car.
Right, the dumb islands.
That old system is called a distributed architecture. If you want to add a lane keep assist feature, you literally have to buy a new camera, wire it to a new dedicated microcontroller, and physically run copper wires through the chassis to connect it to the steering motor.
Which adds incredible weight, and weight is the enemy of electric vehicle battery range.
Exactly. A traditional automotive wiring harness can weigh over 150 pounds and stretch for miles. It is an engineering nightmare. A software-defined vehicle throws that entire distributed model in the garbage.
Tosses it out.
It moves to what the industry calls a zonal architecture.
Zonal.
Instead of 150 dumb chips, you divide the car into physical zones: front left, front right, rear. Each zone has a localized hub, and all of those hubs feed into one or two massive central supercomputers.
Like a central brain.
Yes. These central processors take in all the data from the cameras, the radar, the battery sensors, and they control the entire vehicle through a unified software layer.
So NXP is moving from selling 50 cheap, dumb chips per car to selling the massive, hyper-intelligent central brain.
Correct. NXP is supplying these massive foundational processors. On the call, they highlighted the massive design wins for their S32N family.
S32N.
These are incredibly advanced 5-nanometer vehicle compute processors. They also highlighted their S32K family of 16-nanometer zonal processors that act as the regional hubs.
Got it.
But here's the critical pivot for NXP as a business. Hardware is no longer enough.
What do you mean?
If you hand an automaker a massive supercomputer chip, they won't know what to do with it. The complexity of routing data from the brakes to the steering wheel to the infotainment system on a single piece of silicon is too high. You need an incredibly robust software layer to manage the traffic.
And that is where the acquisitions come into play.
Exactly. NXP acquired a company called TT Tech Auto, specifically for their software middleware, a product called MotionWise. Sotomayor referred to this acquisition on the call as an injection of horsepower.
Middleware. That's like the invisible glue, right?
Think of it like an operating system's traffic cop. It ensures that if the Spotify app on your infotainment screen crashes, it doesn't accidentally freeze the data stream, telling your anti-lock brakes to deploy.
Yeah, that would be bad.
It guarantees safety-critical isolation. Sotomayor used a phenomenal analogy himself to describe this complete package. He said NXP aims to deliver a full Sonos architecture to automakers by late 2026.
A Sonos architecture, like the wireless home audio speakers.
Exactly like that.
That is a brilliant way to explain it. If you buy a Sonos speaker for your kitchen and another one for your living room, you don't have to hire an electrician to run speaker wire through your walls.
Yep.
The software natively recognizes them, it syncs the audio perfectly without latency, and you control the entire house from one central app.
Right.
So NXP is saying they want the radar in the front bumper, the steering column, and the battery management system to all instantly recognize each other and sync up perfectly over a single software network, just like a Sonos sound system.
Got it perfectly.
And NXP is providing both the physical speaker, the chip, and the Sonos app, the middleware.
Precisely. And they are deep in these architectural conversations with almost every major automotive OEM globally right now. This is not a transaction. It is a multi-year platform transition.
Sticky.
Very sticky. Once an automaker spends 2 years designing their next generation vehicle around NXP's proprietary Sonos-like hardware and middleware architecture, the switching costs become insurmountable. They are locked into the NXP ecosystem for a decade. It deepens customer stickiness to a level we've never seen in the hardware space.
That perfectly explains the automotive strategy. But you also mentioned a second pillar, physical AI at the edge.
Yes.
I have to push back here too, because the phrase AI has become, frankly, utterly meaningless.
This huge buzzword.
Every company on earth slaps AI on their press release to juice their stock price. When most people hear AI right now, they think of large language models. They think of ChatGPT.
Right. Cloud processing.
They think of massive, hyper-cooled server farms in the desert running tens of thousands of NVIDIA GPUs just to write a poem or generate an image.
Yeah.
So what in the world is physical AI, and how is a company like NXP, which makes chips for factory robots, actually making money on it?
You are right to be cynical about the AI hype cycle. But physical AI is entirely different from cloud AI. Physical AI is the application of artificial intelligence in the real, tangible, physical world, right at the point where the data is collected. We call this the edge.
The edge, okay.
Let's look at the mechanics. If a massive robotic arm on a factory floor is swinging around and a human worker accidentally walks into its path,
Terrifying.
right? You do not have time to take the camera data, compress it, send it over a Wi-Fi network to a cloud server in Virginia, wait for an NVIDIA GPU to analyze the image, and send a signal back telling the robot to stop.
No, the person would be crushed.
The latency alone would result in a fatal accident. The decision has to be made locally, on the machine itself, in milliseconds.
So the intelligence has to live physically inside the camera or the robot arm itself.
Yes, and NXP is actively shifting its identity to own this space. They already dominate the market for basic industrial chips with their IMX family of processors. But a standard CPU processor is terrible at running AI models.
Why? I need you to explain the mathematical difference. Why can't a normal chip run AI effectively?
Okay, think of a traditional CPU, like a single brilliant math professor.
Okay.
This professor can solve any incredibly complex sequential logic problem you give them one at a time, incredibly fast. That's great for running an operating system.
Makes sense.
But artificial intelligence doesn't require complex calculus. AI requires doing millions of very simple basic probability calculations simultaneously. A CPU creates a bottleneck. To do AI efficiently, you need a neural processing unit or an NPU.
An NPU.
Think of an NPU not as a single professor, but as a stadium filled with 10,000 middle school students.
Okay.
None of them can do calculus, but if you ask all 10,000 of them to do a basic addition problem at the exact same second, they can process a massive data set instantly. That parallel processing is what makes AI work.
And NXP didn't have that technology natively, which is why they bought a company called Kinara.
Exactly. NXP acquired the Kinara NPU technology, and they are now physically integrating it directly next to their traditional IMX processors on the same piece of silicon. They are giving these industrial devices a localized brain capable of running complex AI models without ever talking to the cloud.
Wow.
Sotomayor listed very specific, tangible examples of where customer interest is exploding. He talked about medical imaging systems that can instantly detect anomalies on an ultrasound in real time. He talked about advanced logistics automation in massive warehouses where drones navigate dynamically.
My favorite example from the call was the camera-based workplace safety systems.
Yes.
It's not a dumb security camera feeding video to a bored guard in a control room. It's a camera with an NPU brain built in that instantly recognizes a forklift is moving too fast near a pedestrian, and it automatically triggers a localized warning or physically shuts down the forklift.
Exactly.
That is actionable real-world technology, and it suddenly explains why that industrial and IoT segment surged 20% in the fourth quarter. Customers are waking up to this capability.
Sotomayor noted that customer interest in this specific Kinara IMX combination has been exceptionally strong. It completely validates their R&D strategy. They aren't just selling a raw piece of silicon anymore. They are selling a complete system portfolio that de-risks the AI transition for slow-moving industrial companies.
So let me summarize this massive strategic pivot. NXP survived a brutal inventory purge in the first half of the year. They looked at their portfolio, ruthlessly cut the low-margin sensor business, and took a $90 million hit to kill the dead-end RF power division. They took all the cash and engineering talent they saved and pushed it into the center of the table on software-defined vehicles and localized physical AI. They proved they have the vision.
They absolutely do.
But a grand vision and a Sonos analogy don't pay the bills today. If these automakers and factory managers are actually adopting this architecture right now, we should see it showing up in the immediate projections. Did management actually put their money where their mouth is for Q1? What did they guide for the immediate future?
The guidance they laid out was incredibly strong, frankly much better than the cautious analysts anticipated. For Q1 2026, NXP is projecting total revenue of $3.15 billion.
Okay, I have to stop you because a listener is going to catch this math. You said Q4 revenue was $3.34 billion. A guide of $3.15 billion is a sequential decline of almost $200 million. Why is that strong?
Because of the rigid seasonality of the semiconductor industry. A sequential decline of roughly 6% from Q4 to Q1 is completely normal and expected.
Oh, because of the holidays.
Yes, the beginning of the year is historically softer as factories reset after the massive holiday production builds. The critical defining metric is the year-over-year comparison. That $3.15 billion guide represents an 11% increase versus the same exact quarter last year.
Okay. Posting double-digit year-over-year growth during your weakest seasonal quarter is the definition of momentum.
And the internal breakdown of that 11% growth is what proves the structural thesis. They expect every single geographic region and every single end market to be up year over year.
Everything is up.
Automotive is guided up in the mid-single digits. Mobile is expected to be up in the mid-teens. And industrial and IoT is guided to explode upward in the low 20% range yet again.
That is staggering performance, especially when you factor in the divestitures. This Q1 guidance only includes about 1 month of revenue, roughly $25 million from that MEMS sensor business before the sale to STMicro officially closed. So they are projecting 11% total corporate growth while effectively missing a massive chunk of their legacy revenue base. It proves genuine organic acceleration.
The core is growing fast.
But I am bringing back my red flag, and this time I'm waving it aggressively.
Let's see it.
We have to talk about the inventory move. This was the most contentious, heavily debated part of the entire earnings call, and if I am a retail investor, this is the part that makes the hair on the back of my neck stand up. Explain what management announced regarding distribution channel inventory.
Right. To understand the controversy, we have to define the mechanics of the channel. NXP doesn't sell all its chips directly to Ford or Apple. A massive portion of their business flows through third-party distributors. Massive logistics companies like Arrow Electronics or Avnet.
Okay.
These distributors buy the chips from NXP, hold them in their own warehouses, and sell them piecemeal to thousands of smaller customers in a model called a turns business.
Right, the middlemen.
Exactly. The amount of NXP chips sitting on those distributor shelves is measured in weeks of inventory. NXP ended Q4 with 10 weeks of inventory in the channel. But on the call, management explicitly stated that they are intentionally shifting their strategy to hold 11 weeks of channel inventory throughout 2026.
Stop right there. I am not buying this logic at all. Let's review history. NXP spent the entire first half of 2025 bleeding out, suffering compressed margins and stalled revenue, precisely because there were too many chips sitting on those exact distributor shelves.
Right, it was a bloodbath.
It was a crisis of oversupply. Now, the absolute second they finally crawl their way out of that dish and stabilize the business, management announces they are intentionally expanding channel inventory by a full week.
I know how it sounds.
Are they out of their minds? Is management getting ahead of their skis here? Are they risking triggering another massive supply glut just to artificially stuff the channel and make their short-term Q1 revenue numbers look better for Wall Street?
It is the most vital, dangerous question to ask, and it is exactly the mechanism Tom O'Malley from Barclays attacked right out of the gate in the Q&A session.
I'm glad someone asked it.
Sotomayor and Betts knew this question was coming, and we need to meticulously unpack the distinction they made between channel stuffing and demand staging.
Demand staging.
They were explicitly clear that this Q1 guide does not assume blind, broad-based restocking. They aren't just calling up Arrow Electronics and forcing them to buy pallets of random older chips to hit a quarterly revenue target.
Oh, I would hope not.
Sotomayor clarified that moving from a 10-week target to an 11-week target is a strategic, mathematical reflection of an actual, tangible, improving demand environment on the ground.
But how do they actually know the demand is real? The exact same thing happened in 2022. Customers swore they needed chips, but they were just double ordering because they were terrified of future shortages. What specific hard metric proves this isn't just phantom panic buying 2.0?
Because of the specific high-frequency internal metrics NXP tracks, which Bill Betts laid out to defend the move, they aren't relying on customer promises. They are looking at the math.
What math?
Over the last 90 days, their distribution backlog, the actual contracted orders placed by end customers, has grown significantly.
Okay, contracts are good.
Furthermore, the number of customer escalations has increased. An escalation is a line-down situation. It's when a factory manager calls screaming, because they're literally going to have to shut down a manufacturing line tomorrow if they don't get a specific NXP chip.
Oh, wow.
When escalations rise, you know the inventory in the system is genuinely depleted. Finally, the short-term order rates, the velocity at which chips are moving off the distributor shelves, have accelerated.
So they have hard data showing the velocity of consumption is increasing.
Exactly. And furthermore, they maintain strict discipline over what specific chips they are shipping into the channel. They're not shipping legacy products. They are prioritizing the sell-through of highly demanded specialized products like the S32 vehicle processors and the IMX industrial chips that are required for the new architectures we discussed.
So it's not just junk inventory.
No, it's the good stuff. Staging an 11-week supply isn't a return to the hubris of 2023. It is a confident, calculated logistical response to ensure they can actually service the real, accelerating demand they're tracking in real time. If they stay at 10 weeks, they risk missing sales because distributors won't have the specific parts on hand when a localized factory needs them.
So management's defense is essentially, we aren't artificially stuffing the channel. We are adequately stocking the shelves because our data proves the store is getting crowded with actual buyers.
Precisely. And to further assuage fears that NXP is just overproducing generally, Bill Betts brought up internal inventory.
Internal inventory.
This is the raw silicon sitting on NXP's own balance sheet before it ever gets shipped to a distributor. They ended 2025 holding about 154 days of internal inventory.
That seems like a lot.
Betts noted that this elevated number included about 7 days of strategic pre-builds. They intentionally overmanufactured some specific chips because they are in the process of consolidating some of their older manufacturing facilities, and they need a buffer during the transition.
Okay, that makes logistical sense.
But Betts explicitly committed to Wall Street that as revenue growth accelerates throughout 2026, they expect their internal working capital efficiency to improve, meaning they're going to actively draw down those internal inventory days. They're managing the tightrope of supply and demand very carefully.
Okay. You and management have successfully talked me off the ledge.
Good to hear.
I will lower my red flag on the inventory issue for now, but I want to make this crystal clear for anyone listening. This is the metric you need to watch like a hawk in the upcoming Q1 and Q2 reports. If that channel inventory creeps from 11 weeks to 12 or 13 weeks, the warning sirens should start blaring because the narrative will have broken.
Absolutely. Watch that number.
Let's pivot away from the short-term inventory kinetics and look at the second half of management's guidance, which revolves around capital allocation. We established they are generating $793 million in free cash flow a quarter. What exactly are they doing with that mountain of cash?
Their capital allocation framework is a masterclass in shareholder value, and it remains remarkably consistent. Over the last 10 years, NXP has returned over $23 billion directly to their shareholders.
$23 billion.
That represents roughly 95% of their total free cash flow generated over a decade. And they do this primarily through massive, sustained, and disciplined share buybacks. Over that 10-year period, they have reduced their fully diluted share count by a staggering 27%.
I want to pause on that number because it is wealth creation in its absolute purest, most mathematical form. If you bought one single share of NXP 10 years ago and just went to sleep, your actual ownership percentage of the underlying business and your claim on their future profits has mathematically grown by over a quarter.
Yep.
You didn't do anything. The business just bought out your partners and retired their shares. Did they keep that engine running in Q4?
Absolutely. In Q4 alone, they returned $338 million through stock buybacks and distributed another $254 million via dividends. And they are proactive with their debt profile.
Paying down debt.
Yeah, just days into January, they used cash on hand to completely redeem $500 million in debt notes that weren't even due until March 2026.
Yeah.
They were meticulously cleaning up the balance sheet.
It is beautiful textbook financial engineering, but you don't survive in the semiconductor industry just by buying back stock. You have to manufacture physical atoms.
Yeah.
And this brings us to a massive multi-billion-dollar storyline that dominated the capital expenditure section of the call. We need to dissect the alphabet soup of joint ventures. The transcript is filled with references to TSMC, VSMC, and ESMC. What is the strategy here?
This is NXP's hybrid manufacturing strategy, and it is the absolute key to their long-term margin expansion and geopolitical survival.
Okay, unpack that for us.
To understand why they are doing this, you have to understand the terrifying economics of building a modern semiconductor fab. To build a single leading-edge facility today, you need to buy extreme ultraviolet or EUV lithography machines from ASML that cost hundreds of millions of dollars each.
Just for one machine.
Just for one. The total cost of a new fab easily exceeds $20 billion. If a company like NXP builds a $20 billion fab on their own and the chip cycle turns against them, leaving the factory half empty, the fixed depreciation costs will bankrupt the company. It is a fast track to financial ruin.
So they refuse to build the factories themselves.
Exactly. Instead, they form joint ventures, or JVs, with the undisputed king of global chip manufacturing, Taiwan Semiconductor Manufacturing Company, or TSMC. NXP is currently deep into a massive $3.4 billion investment cycle across two major joint ventures, VSMC and ESMC.
Okay, $3.4 billion is a colossal capital commitment for a company of this size. Where does that money actually go, and what are VSMC and ESMC?
VSMC is Vanguard International Semiconductor, a joint venture based in Singapore focused on 130 nanometer to 40 nanometer analog and power chips.
Okay, Singapore.
ESMC is the European Semiconductor Manufacturing Company, a massive joint venture being built in Dresden, Germany, focused heavily on the advanced FinFET automotive chips.
Okay, Germany.
So far, NXP has invested about $1.7 billion into these projects, roughly 50% of the total plan. The cash outlays are fascinating. In Q4, they made a $195 million payment simply for what they call capacity access fees.
Wait, they literally paid almost $200 million just for the contractual right to be at the front of the line when the factory opens?
Exactly, just to hold their spot. They also made a $282 million direct equity payment into the ESMC project in Singapore and a $44 million equity payment into the ESMC project in Germany.
Why spread it across the globe like that? Why Singapore and Germany?
Supply chain sovereignty and geopolitical resiliency. If the last 5 years taught the auto industry anything, it is that relying entirely on a single factory in Taiwan for the chips that run your cars is an unacceptable geopolitical risk.
It's way too fragile.
By co-investing in these geographically diverse fabs in Europe and Southeast Asia, supported heavily by government subsidies like the European GPS Act, NXP guarantees they will have the physical wafer capacity they need for their next generation SDV and AI chips, insulating them from future global supply shocks.
But beyond just guaranteeing supply, what is the actual financial payoff for NXP shareholders for tying up $3.4 billion in concrete and lithography machines?
The payoff is a structural, permanent, and massive boost to their profitability. Bill Betts stated explicitly on the call that when the VSMC fab in Singapore is fully loaded and operational in 2028, the favorable economics of this joint venture model will lift NXP's overall corporate gross margin by a massive 200 basis points.
Wow. 2 full percentage points of pure margin expansion across the entire corporation. On a multi-billion-dollar revenue base, that is an incredible amount of operating leverage.
It's going to be huge for them.
We have covered immense ground today. We have dissected the revenue and margin beats of Q4. We've explored the brutal reality of the semiconductor cycle and the strategic, ruthless pivot away from dead-end RF infrastructure and directly into the heart of software-defined vehicles and physical edge AI.
We hit it all.
We've debated the channel inventory mechanics and broken down the multi-billion-dollar joint venture strategy. Now it is time to bring it all together.
The verdict.
Yes, the verdict. If I'm sitting at home, looking at my brokerage account, trying to decide what to do with my capital regarding NXPI, what is the ultimate verdict? After reading the entire transcript and analyzing the data, are we calling this earnings report a bullish or a bearish signal?
Based on the preponderance of the hard data, the aggressive and successful structural shifts in their product portfolio, and the absolute clarity of management's financial execution, we are firmly, unequivocally calling this a bullish signal.
A firm bullish rating. Let's synthesize the fundamental why behind that verdict. For me, it boils down to a single, powerful concept that Rafael Sotomayor hammered on repeatedly during the Q&A session. The transition from cyclical dependency to structural growth.
That is the crux of the entire investment thesis. For decades, the math on auto chip stocks was incredibly simple. If you wanted to know if a company like NXP was going to have a good year, you just looked at the SAAR, the seasonally adjusted annual rate of global vehicle production.
Right. How many cars are being built?
Exactly. If Ford, Toyota, and Volkswagen built 90 million cars, NXP made a certain amount of money. If the economy boomed and they built 100 million cars, NXP made more money. The chip makers were entirely hostage to the macroeconomic cycle of car sales. It was purely cyclical.
But you and management are arguing that that math is fundamentally breaking down in a highly favorable way for NXP.
Right. Let's look at the projections for 2026. Global car production is currently forecast to stay roughly flat, hovering around 93 million vehicles globally.
So flat production.
If NXP was purely cyclical, their auto revenue should be totally flat, but they are projecting robust growth. Why?
Because of the content.
Exactly, because the content per vehicle, the actual bill of materials or BOS inside each car, is skyrocketing.
Explain the math on that content growth.
Even if a legacy automaker produces the exact same number of cars next year as they did this year, the composition of those cars is radically different. They have to transition a higher percentage of those models to electric drivetrains, which require massive battery management chips.
And more safety features.
Right. They have to add highly advanced 77 gigahertz radar systems just to pass the new stringent European safety ratings. And, as we discussed, they desperately have to shift to that centralized software-defined vehicle architecture just to remain competitive with the speed of innovation coming from Tesla and the rising Chinese OEMs.
So more chips per car.
A traditional combustion engine car might have contained $500 worth of NXP silicon. A next-generation zonal architecture EV could easily contain $1,500 or more of NXP silicon.
Tripling the value per car.
Every single one of these industry mandates requires exponentially more processing power per chassis. The total pie of 93 million cars isn't growing, but NXP's slice of each individual car is getting massively thicker.
That is the definition of a structural tailwind. The cyclical storm of the 2025 inventory glut has officially passed, and they are now riding a massive, unstoppable structural wave of architectural transformation in the two most important physical markets on Earth: automotive compute and industrial edge AI.
It really is a powerful setup.
So let's translate this massive macro thesis into actionable takeaways for the retail investor listening right now. If you are currently holding NXPI in your portfolio, what should you do?
Well,
my take is that this earnings call was management proving to you that they are ruthless, unsentimental capital allocators. They don't fall in love with their own technology. They will completely kill an underperforming segment like RF power, take the $90 million hit on the chin, and walk away just to protect your margins.
exactly.
They will sell a $900 million sensor business simply because they don't like the long-term foundry dynamics of being a middleman. And they do all of this while quietly continuing a 10-year track record of shrinking the share float and steadily raising the dividend. If you hold this stock, you hold it with immense confidence. Management is doing exactly what they are paid to do.
I agree completely. And if you are an investor who is currently sitting on the sidelines considering buying the stock, the primary takeaway is that you need to fundamentally reframe how you view this company. You aren't just buying a legacy supplier of basic analog radio chips for car dashboards anymore. You are buying into a heavily de-risked physical AI and smart vehicle software platform. They have the vision, they have the middleware software layer to make it sticky, and they are actively funding the high-margin manufacturing capabilities in Europe and Asia to support that vision securely.
And the entry point.
The entry point here is highly compelling because the inherent earnings power of the business is expanding significantly faster than the end markets they actually serve.
So the absolute bottom line for you, the listener, the cyclical storm is over, the dead weight of legacy tech has been cut, and the engine driving this company through 2026 is fueled by the unstoppable march towards smarter, centralized cars and localized factory AI.
It is a textbook masterclass example of a company using the pain of a cyclical downturn to structurally improve their business model for the inevitable economic upswing.
Now, before we let you go, we always like to leave you with one final provocative thought. Something to mull over, debate, or research on your own that wasn't the main headline of the press release, but could be a massive hidden wildcard for the future of the stock.
And for NXP, that hidden gem was buried deep at the very end of the Q&A session.
Oh, I know what you're going to say.
Analyst William Stein from Truist Securities asked a question that almost felt entirely out of place for an automotive chip company. He asked about data center AI exposure.
Right. I saw that and scratched my head. NXP is an auto and industrial company. They don't make the massive $40,000 GPUs that NVIDIA sells to power massive language models. They have nothing to do with training ChatGPT. Why in the world would an analyst ask about their data center exposure?
That is the common assumption. But Sotomayor's answer was incredibly eye-opening. He quietly admitted that, hidden within their industrial segment, NXP is actively supplying critical physical infrastructure components to massive AI data centers.
What exactly are they supplying?
Specifically, they supply highly advanced power supply microcontrollers. Think about a massive server rack running 50 NVIDIA GPUs. The heat generated is apocalyptic.
It's a furnace?
Traditional air cooling no longer works. These data centers are moving to complex liquid cooling systems. NXP provides the localized processors and control functions that physically manage the liquid cooling pumps and thermal regulation of those server racks.
That's wild.
He also specifically mentioned PQC post-quantum cryptography. As AI scales, the security of the server racks becomes paramount. NXP is supplying advanced security chips to protect the physical servers from localized tampering. And Sotomayor casually noted that this unhyped, unmodeled revenue stream is, quote, growing nicely.
Growing nicely. That is absolutely fascinating. While every retail investor and hedge fund on Wall Street is obsessing over the shiny, expensive AI GPUs, NXP is quietly selling the physical picks, shovels, and plumbing required to keep those massive server farms from literally melting down into slag.
It's the ultimate stealth play.
Could this hidden, unhyped infrastructure play be the massive wild card that the market is completely underpricing in NXP's stock? Are they secretly a stealth data center AI infrastructure play?
It is a phenomenal question that every investor looking at this space should be asking. It provides yet another entirely distinct layer of structural growth outside of their core automotive market.
It certainly makes you look at your own portfolio differently. I highly encourage you to review your holdings this week and ask yourself a fundamental question. Do you have enough exposure to the physical plumbing of the AI revolution?
Exactly.
And more importantly, do you have enough exposure to physical AI executing in the real, tangible world of factories and cars rather than just chatbots in the cloud? We started this deep dive talking about the terrifying roller coaster of the semiconductor cycle. The blindness, the stomach-dropping free fall of inventory corrections, the anxiety of holding a physical tech stock.
It's not for the faint of heart.
No, it's not. But what we've discovered today by digging into the actual mechanics and data of NXP's Q4 results is that they haven't just passively survived the ride. They've been quietly and ruthlessly rebuilding the tracks underneath them while the car was moving. They've swapped out the rickety wooden cyclical supports for solid structural steel.
You might still feel some bumps along the way. Macroeconomics still exist, and it is still the physical semiconductor industry after all. But when a company proves it can control its channel inventory with data, fiercely defend its gross margins by cutting weak divisions, and align its entire R&D budget with the massive architectural modernization of the global automotive fleet,
the ride becomes a lot less terrifying.
Exactly. You aren't just a blindfolded passenger hoping the tracks hold together anymore. You're riding alongside the engineers who are redesigning the entire theme park.
Beautifully said. Thank you for joining us on this deep dive. We stripped away the noise, focused on the numbers, unpacked the mechanics behind the jargon, and hopefully gave you the clarity you need to navigate this incredibly complex sector.
Until next time.
Keep your eyes on the data and stay invested.